Good morning, remisers and clients. Thank you so much for tuning in to our weekly morning call. It's Joshua here, the head of research. Today we'll be talking mainly about macro and market strategy to give you an update of what's going on in the world and what's going on with markets. And also we're going to go through our topic list. So without further ado, I will hand you over to Linton, who will start with China and ASEAN macro.
Good morning, everyone. This is Linton, your macro analyst. So just to give you a brief overview on China and ASEAN updates. So basically for this region, the key challenges remains as external demand, sluggish external demand, but we expect a cyclical recovery in the second half this year, as well as structural reforms in some of the countries, in particular China, as well as Indonesia after their elections. Then these structural reforms actually we expect that it may cause some sort of short-term volatility, but it will be beneficial in the long term. And in general, we see weakness such as high leverage in certain countries like China, weaker productivity growth, and weakening currency, as well as weakening commodity, in particular agricultural prices, which may affect agriculture exports driven countries like Thailand as well as Indonesia. As for due to all this weakness in fundamentals, we may see exodus of funds when the US starts to hike their interest rates as soon as next year. Okay, moving on to China. So we actually see that the economy is stabilizing with both manufacturing and non-manufacturing PMIs extending above 50-point level. Both official and HSBC's data consistent. However, risk remains with shadow banking system as well as the real estate bubble. But we do see that there are evident progress in China's structural reform agenda and measures to bolster growth, which is also known as the mini stimulus package. This will in turn becomes a catalyst for a turn in sentiment as well as valuations for the equity market. These are just a few of the ongoing things that we see on what are the China authorities are doing currently. As for Singapore, fundamentals remain solid, and we expect that the country will benefit from global cyclical recovery. Aging population, tightening labor supply, as well as increasing business costs remain as a drag on potential growth. For Indonesia, as all of us know that they are going to have their presidential elections coming on this Wednesday. We see in the current current progress, we see neck and neck race between Jokowi as well and his main rival Prabowo, which kept investors on edge, and we see that the equity markets are actually moving sideways. And we expect that market will respond positively to victory by Jokowi, who are actually propose a more investor-friendly growth plan compared to Prabowo's debt-driven and nationalistic growth plan. Both of the candidates actually pledged to boost economic growth to 7% and to create more job opportunities. But this will remain as but however, to achieve this, budget deficit will remain as a key constraint, as the current fiscal deficit is actually reaching the 3% of GDP statutory ceiling, and opening up policy would be a key to boost economy and to sustain growth. As for Thailand, since we already had a Thailand macro update last week, so I'll just briefly bring you through a Thailand update. So for Thailand, we see more political stability after the May 22 coup, and fundamentals are improving. Economy expected to pick up, especially in the public and private spending in the second half, as the three-phase roadmap is on track. So headwinds remains as fears of persistent political instability, possible suspension of EU cooperation with Thailand, the energy reform, as well as the capital market tax overhaul, which may dampen the market sentiment. As for Malaysia, we see resilient domestic demand as well as exports recovery are expected to continue to support the economy. And headwinds remains as the cost push inflation, which we may be seeing a second round in electricity tariff as well as fuel price hike in the second half. And we are also expecting that the GST next year will also drive up, will cause an inflation spike next year. So and as well as the elevated credit risk, as the nation is currently debt-ridden. But we are expecting that this will likely to improve with ongoing fiscal consolidation as well as the widening tax base. So moving on, I will pass the presentation to Josh on macro view on US and Eurozone.
Thanks, Nitin. Okay, data in the US has been exceeding expectations. Pretty much all the range of indicators have been doing pretty well, from lead indicators, employment indicators, industrial production, sales, and basically it looks pretty robust and swimmingly good in the US. And so we see a resilient economic expansion there. We still should not expect a 3% expansion, but actually a 2% odd expansion. So it's really not going to be what we're used to in the last bull market, right? Those days are pretty much over. But I think the direction is solid, and 2% is good enough. Okay, so conditions in the U.S. credit markets remain pretty okay despite the ongoing tapering program. Yields have not risen that much, and having said that, still rather low. Okay, the key risks remain housing market, where sales and construction activity continues to struggle. But like I've said, most of the other indicators are going pretty well. Now, the Eurozone is in a moderate recovery. So we're not expecting too much from the Eurozone. As you know, they still have a balance sheet recession there. Lending remains rather weak, but at least the direction is solidly in the improving direction. Manufacturing and services are okay and have been at the fastest pace since May 2011. Now, the key risk facing the Eurozone is deflation or a growth slowdown. Right, but having said that, the ECB is taking that threat very seriously, and we've seen negative interest rates, which have been unprecedented, and also they have not been averse to a QE path should they need it. Okay, Japan, economic activity there increased Q1. We still have some structural weaknesses like fiscal and external balances, which are the main things weighing on growth. But also on the whole, we're positive on Japan. The equity market there is trading at a forward basis of close to 15, whereas the long-term average is 17. So we actually see more upside in Japan. The key risk is the inability to implement structural reforms. So we have reports on all these countries that we've mentioned. They are in poems, and basically, if you go to Singapore research, and if you go to strategy, under Singapore, basically you have reports on all these countries. These reports would also show unit trusts that proxy these countries. And if you're a financial advisor, I think it would be very useful if you had a read of them. Okay, so let me just summarize. Globally, economic growth is on track. Inflation actually has seen a little bit of an uptick, but it's still far too low to shift monetary policy into a tightening mode. Bonds are much more relatively expensive compared to stocks at the moment, as bond yields are still at record lows, despite having risen a little bit. And I think with growth on the uptick, inflation probably has more upside than downside. And given that, the best place to be is probably stocks. So we think that the great rotation out of bonds into stocks is likely to continue. Now the question, are there any more macro risks? These past few years have been volatile, full of macro risks. So we would say that there is one on the horizon, which is China's real estate bubble and shadow banking system. That is a macro risk. But if you ask any any research house, they would probably put this on the macro risk table. And hence, if everyone's looking at it, history has shown it's quite unlikely to implode, right, if everyone's calling that as a risk. Authorities in China as well are quite on top of this risk and have been actively managing it. Okay, so before I move you on to Kenneth, who will talk about the technical market outlook, I just want to reiterate some of the picks that we've put out over the last 2-3 months, and we've had conviction calls on them. And basically, the first one is Valuetronics. It's an electronic contract manufacturer. However, net margins are 6%, which is double the industry average, so it must be doing something right. And that business model is actually the fact that it does full turnkey outsourcing from the product design, the whole product design, to mass production, and its customers are niche leaders in their products. So this segment is driving the growth, and it's about 40% of revenue. Basically, we're going to see, we have a very conservative growth forecast, about mid-single digit per year, but management is more optimistic than us. Now, given that valuations are super cheap because it's at 5.3 times PE, and that's taking a 40% discount to the net cash, because we think they need to hold some of that net cash to give their customers confidence in outsourcing their total production lines to them. And that means 60% is available for shareholders. Now, so given that it's growing at single digit, 5.3 times PE is really very cheap. And we have a 7.6% dividend yield currently on a 50% payout ratio. Because the company generates very strong free cash, we think this payout ratio can be increased. And I think that would serve as further catalyst to the stock, which has already performed very well since initiation at 33 cents. Right now it's at 43, and the target price is 60.5. And on top of that, you'll get a 7.6% yield. Now, Lantrovision is a premium structured cabler. It services Fortune 500 financial institutions, tech giants, governments, and is a proxy to the data center growth industry in Singapore. Right. Its key economic moat is that it has a global alliance with other premium structured cablers in the US and Europe, which means it can go for the global structured cabling contracts. Now, market cap's 151 mil, net cash 82 mil, earnings is about 13.2. So also it's a super cheap valuations for a free cash flowing business at 5.2 times PE ex cash. Our next top pick is Croesus Retail Trust. As you know, we are positive on the Japanese economy. Basically, it holds a portfolio of Japanese retail malls, and we're seeing rental renewal and 2 acquisitions, which will probably drive DPU to over 9 cents this year, which means it's trading at a forward yield of 9.5%. And I think that, coupled with the upside from 96.5 to 112 as our target price, I think there will be a handsome return. Okay, we're still positive on our previous picks. Boston and Penn United have risen almost 12% year to date. OUE and M1 are near target price, so I think we'll probably have to remove them from the top of this. Silver Lake Access has totally exceeded the target price. Okay, so I will move you on to Kenneth right now.
Hello everyone, good morning, Kenneth here. I'm the market analyst. Okay, I think you've heard from Joshua and Linsin about the economic climate. That essentially, by and large, globally news is more positive than negative, and the underlying base for a bull market is still there. Okay, so, for the market technicals, I call it an updrift on liquidity and good news, part 3. But I'm going to give you the conclusion before I finish with the market technical outlook, and it's like this. Even though the stock market may seem overbought and ripe for correction, and today I'm going to show you what's underlying the stock market, economic indicators clearly support a long-term trend in stocks. So we do think there's a longer bull run. The economic fundamentals support a longer-term bull run, but we do think that we are quite overstretched, overbought, and ripe for correction. Okay. For our previous technical analysis outlook for the US market, please refer to this particular webinar over here, Singapore Macro Technical Analysis, dated February 10th. Okay. Okay. So let's just start with what was said way back in February. So February 2014, this is the points that were said at that point. Okay. Now we see that first point was that the probability is that the US market's bull market has not ended yet. We guided this since December 2013, and so far that essentially has been correct. Okay. Second, there was going to be a minor and major correction early May, and now we're waiting for what could be a next correction. Okay. We also mentioned that the STI Singapore the Straits Times Index had a chance to cycle up until the meaningful correction in S&P starts due to relative valuations, and we guided this since April, beginning of April, and by and large this is also correct. So the S&P correction, a meaningful correction, has not occurred yet, and true enough, the STI has indeed cycled up. Okay, so we got nailed this one, and so now what about this correction? Okay, so obviously technical analysis is all based on probabilities. We can give you the rough time frames of when something should happen, and then we check the signs of the market to see what's the probability of it happening. So what we're going to do today is we're going to look at the underlyings of the market, that is not just based on price alone, but other things, to see where we are in terms of sentiment, overstretchness, etc., etc. Okay, so that's what we're going to do. Let's explore this together. Okay, just a quick update. This is basically a 3-year chart of the S&P over here on the top. And at the bottom, we have the 3-year of the Straits Times Index. And you can see basically that as the S&P has been on an uptrend all this while, and all corrections have been minor, no major ones. Okay, the STI indeed has cycled up since April, okay, as guided. Okay, next. Okay, so now we're gonna look at the intermarket and sector rotation models just to ascertain exactly where we are. All right. So this particular slide, this is the outlook exact slide that we had on the 11th of January's POEMS market outlook presentation. Over here, we mentioned 3 points: that the bond market is in the early bear stage. Okay, you should be longing stocks, especially industrials, materials, and energy later on. And we also mentioned to long commodities, but wait for a breakout. Okay, these are the 3 things that we guided early in the year. And we also made the case that we are at stage 4 of the business cycle, in which case you're actually mid-bull right now. Almost at the end, but not really. Okay, so at this stage, bonds are supposed to go on a longer-term bear trend. Stocks still have some legs, and commodities are halfway up. Okay, so since then, now this is the slide that we presented since then. Okay, we showed you that the top slide here is the US Treasury slide. Second one is the Dow Jones World Index, is a proxy to the world stock market. Third one is the GSCI Industrial Commodity Index. Okay, and essentially what I want to point out is that for this slide, I drew this line here, but instead of saying that this is a downtrend, I said that this is actually consolidating. In other words, I expect there to be a move higher up, and this is just a consolidation within that move. Okay, so what happens now? Now this is the updated chart. As you can see that bonds is consolidating here, and we expect it to eventually break downwards. Stocks is still on the uptrend, and the commodity market has indeed broken out on the upside. Okay, it's on its first few legs for the past 2 months, broken out for the upside. Okay, so that corroborates what we talked about. Okay, sector glances. So here, this is the intermarket analysis where we compared the treasury market, the stock market, and the commodity market to see where we are in the business cycle, to see where we could be on the bull market. Okay, and now we'll do the same thing but for sector rotation. Okay, so just a quick one. I won't spend too long because I have explained this a couple of times already, and if you want more detailed explanation of these things, I'd like to refer you back to our February presentation where I went into more detail. But basically, I'm just going to recap this. These are the 9 different sectors of the S&P, so the cyclicals, technology, etc. This is the price pattern with 2 moving averages on it. At first glance, they all look like an uptrend, so you can't really see very much. All you know is that they're on an uptrend. But for all intents and purposes, you can gather some information if you look at their relative strength. So underneath each chart, I've now put in the relative strength of that sector as compared to the S&P as a whole. And when you do that, you'll see that even though every price is in an uptrend, you now can see that some of them simply are not, some are outperforming the other. Like for the cyclicals, it actually had turned down in terms of performance. Technology is up. Industrials might be turning a little bit, okay, but more importantly, you can see how energy has suddenly cycled up, for example. And that consumer staples, which is a defensive stock, not only is it on a downtrend, the relative strength, but it also cycled down as well. Okay, so these things tell us certain things. What does it tell us? Well, I'm going to make a case that we are still basically within this phase of the market cycle, which favors industrials, basic materials, and energy. Remember, I just showed you that energy started to make a pop, right? So it's over here. And this stage here actually corroborates to the stage 4 that we talked about earlier. This is the sector. This is a summary of the sector performance, relative performances. Okay, very quickly, the bottom axis here is the relative strength. So if you're on the left, you have weak relative strength. If you're on the right, you have outperforming relative strength. The y-intercept is your relative strength momentum. It measures how fast your relative strength is increasing or decreasing. So if you are on the top, it means that your momentum is increasing, and if you're at the bottom, it's decreasing. So what does that mean? It means like this. These are your sectors. In this case here, this particular square here is your telecommunications. Technology. Okay, this is consumer staples. Okay, this is consumer discretionary, for example. So in these sectors here, you can see based on which quadrant they're in, that's the state at which they are. So if you're on the top right, you are actually leading. You're leading the rest of the sectors. If you're top left, you are improving. By and large, in general, you usually see these sectors rotating, and that gives you a hint as to where you are in the business cycle and what comes next. So if you see certain sectors outperforming, you know that the other sectors will be coming soon. What I want to just point out in this particular case, and by the way, each trail before it, right, signifies 1 quarter, 3 months. So this is a 12-quarter trail. It tells you where this has been in the last 3 years, which is like half a cycle or almost a full cycle. Okay, so the point I want to note is this. Right now, energy is improving. Materials led energy, right? It's in front of energy. Okay, but both of them are improving. They're not leading yet. And the top of the bull market usually, okay, if the business cycle is ideal is characterized by energy leading for a while, because that usually means that inflation is basically going out of control, and that leads to basically energy stocks doing well. So energy is not yet at this leading segment. That gives us some time to that we can one reason that we can say that the top of the bull market has not occurred yet. So this is one way of using this clock as I see it. Okay. Now, if you want to know how the sectors performed in the last bull market top, which is this is the chart, the sector rotation chart from August 1st, 2007, which is basically the last bull market top. You can see the energy is in the leading quadrant and that materials are also leading, right, and turning down. So this just gives you a snapshot as what it might look like. And just to value add to you, our dear investors, here is what the market bottom looks like. This is March 2009. And you can see in this point in time, you can see basically all your offensive sectors like industrials and materials and financials, they're all lagging badly, but turning up, right? So this gives you an idea of what to look for. I hope this is helpful to you guys. Okay, that being said, let's talk about the actual price itself. The S&P and the STI, this is your basically your decade-long plus chart. Okay, you can see the two cycles here. It's up. Okay, right. So, few things to say. Well, we know that the S&P has actually broken through its all-time high, and that's always very bullish. That's always bullish. Sorry. Okay. I will make the case later on that the price is very extended and is waiting for a reason to correct. Okay. It really is, but it's this reason to correct always gets countered by dovish central banks and relative good news. I mean, central banks, for example, the Fed has had a dovish tone. ECB have had negative interest rates, and inflation is still less than the 2% threshold that the Fed talks about. And so the central banks have a very dovish tone. At the same time, there has been actually good news. I mean, China PMI has improvement. On US employment, that has also continued to improve. Eurozone is improvement. So with a slew of good news, right, you still need some bad news for a correction to occur, and that's not been happening. Let's look closer at the market itself. How bullish really is this move in the S&P? Okay, but before that, for your information, this is inflation data. Okay, these are personal consumption expenditure price data, and as you can see that as of these 2 months, right, actually inflation numbers is still less than the 2% annualized, which is the Fed threshold. It's ticking higher, right, but there's still some ways to go. Okay, so the Fed will not be pressurized to increase interest rates until the 2% threshold is hit. So this is good for central banks' sentiment. Okay, dynamic yield curve. The spread between low-yielding, long-term and short-term treasuries is still nice and wide, as follows. And this phenomenon usually provides a bullish base, a base for a bull market. Okay, so it's not inverted yet. This still supports the bull. Now, on a short term, right, this is basically the sectors, how they performed over the last month, June to July. And as you can see, of this last month, there's been a move from defensive stocks to offensive stocks. You can see that the consumer discretionary tech has started to take leads, right? Energy surged over here, but at the same time, the defensive stocks are lagging, the utilities and staples, right? So what does this mean? I'm not saying that you should pile on your money in these sectors right now, but what it does mean is that this corroborates the economic data that's coming out, right? If the economic data is truly fundamentally bullish for a bull market, you should see the offensive sectors improving, and that's what's basically been happening. Okay, I included this slide because I thought it'd be very useful for you guys. Okay, this basically summarizes the key data for the US. Now, if the data is green, it basically means that it's either improved or positive. Okay, if it's red, means that it's either negative or it deteriorated. Point of it all is that there is more green than red. So net, right, there's more positive economic data coming out from the US. Okay, so now that we talked about economic data and where we are in the business cycle, and we know that we are still in a bull market, let's talk about the actual price chart itself. Okay. Okay, so here's the S&P price chart itself, starting from the March 2009 low. Okay, essentially we have to note that hey, the price is slowly trending towards the top of the bullish channel. Okay, so that is going to provide a resistance. Okay, we don't know whether the bounce will be minor or major at this point, but you have to note that there is resistance here. Okay, yeah. So that's where we are going. So basically the price trend is bullish, hitting top of the resistance channel. Okay, let's look into again, but let's look at other types of indicators to see where we're at. So here's the S&P price again. Okay, that's where we are right now. Okay, all right. Let's talk about the good and the questionable. Right, so it's a little mixed over here. The good. Momentum implies further upside for now. Yeah, you can see our momentum indicators like the MACD, for example, it crossed upwards here, and our RSI is not exactly oversold yet, so that tells me that the probability that this will continue moving up in the short term to hit the channel very, very high. It's most likely going to happen. Okay. At the same time, this particular move finally had a recovery of the Russell as well. Remember, this is our Russell to S&P relative strength chart. Okay, to find out more, check out our February webinar. So it's always good when the Russell outperforms when the price moves up. Okay, so that's good as well. However, I do know that the Russell is coming to resistance soon, and if that resistance coincides with the top of the channel, right, then that could spell a minor to major correction as well. Finally, of course, the trend is up, and that's good too. But here's where I will take pause. Okay, there's some questions I have to ask. Okay, yes, the trend is up. But what's underlying the trend? First of all, VIX. Here's the VIX index. You can see the VIX index is basically at its multi-year low. That shows a great complacency in the market. People are pretty relaxed and pretty confident. Too many people are too confident, I'll say, right? RSI is also almost little stretched. It's almost at its overboughtness. But of course, being in a bull cycle, right, that's not too much of a concern, but we should know that it is, reaching overbought status. The price that we talked about earlier is reaching the top channel resistance. Okay. Here's another key. In this whole move here, that's lasted 3 years, the volume has been slowly decreasing. See? So that's also something to think about. Now, next slide, I'll talk about it soon. Investor intelligence is getting extreme soon. Okay, I'll talk about this later on. So therefore, what's the character like? I think it's possible for a little more updrift. Okay, but I think that at this point in time, protective stops should be in place. So as a technical analyst, right, yes, the uptrend is up, so you really shouldn't bet against the uptrend. Okay, but at the same time, you should put protective stops, a tight one. Okay, because the markets are overstretched and is waiting for an excuse to correct. That's the thing. Okay, so any slew of bad news is going to cause us to correct. Okay, however, the news obviously continues to be good. Now, so suggested pullback. So if there is a pullback, it's probably still part of a larger uptrend, right? Unless the key support is violated. I think a stop at 1800 here, 1800 is probably considered. You should consider this. So if price retraces here, you need to see whether it actually breaks through. If it breaks through, it probably has a second leg down, Okay. Now, what's this investor intelligence? Okay. Here's a chart, the bull-bear ratio. It measures the proportion of investment advisories in the US that is bullish compared to those who are bearish. So a high number essentially means that majority of the investment advisories have a very bullish tone. So as you can see here that we are back up 3 times again. Okay. And basically when you're above 3 times, we like to say essentially that things are too bullish, people are too optimistic. And this usually is indication that we might be overstretched. Okay, might be. So let's look at what happens every time that you are past the ratio of 3. Here's S&P. The red lines here indicate when you are actually above 3. As you can see, essentially every time that you are above 3, it seems to preempt some sort of correction. The only question is it a big one or a small one? Right? So here, 2003, you have a very small correction. Here at the beginning of 2004, you had a series of small corrections. Of course, '07 here is the start of your bear market. But but also to note, the most recent correction that we had earlier this year, okay, as you can see, we also had this overbought nature. Let's go back there again. Can you see the beginning of the year? It was really extreme at about 4, right? And we had that correction. We're not at 4 yet, but we're getting there. Okay, just for your reference, right? A bull bear ratio under 1 signals the opposite. It tells you when things are massively oversold, people are just so negative that you usually can get some sort of corrective move upwards. As you can see here, you can see that most of the time you do have a corrective move upwards, okay? So that's for investor intelligence. So to summarize the US market again, okay, essentially, right, yes, we are on an uptrend, momentum looks good, but in terms of sentiment, okay, it's a little questionable. So you can still bet the bull market, but you should probably put a stop just in case it cycles down. However, I think that the bullish condition can still continue have longer legs because of all the economic data and based on what we think where we are in the intermarket analysis as well as sector rotation. Okay, so unless it's some major crisis, right, we expect the bull market to continue. Okay, so let's go to the Singapore markets now. That was for the US market. Okay, since the US market is essentially the biggest in the world, US economy is the biggest in the world, there's some correlation to that market. Okay, so this is what the roadmap that we painted in February 10th of 2014. Okay, I drew this support zone over here, and I mentioned that short-term bounce is very likely. So since then, you can see that you had that bounce over here. Okay, it cycled up. Okay, we mentioned that. So as of today, here's where we're at. Okay, we have got this chart, it cycled up. So now we are basically at this key resistance zone. This key resistance zone is important because this is this started the intermediate correction down. See, because the bull market broke sharply down here past this support zone right through, bounced off once, now it's back there again. So the question is now we're at this point here. So the price is definitely going to slow down here and correct, which is what's been going on. It's consolidating right now. So the question is does it have a bullish bias or a bearish bias? Okay, is it going to consolidate here, or is it going to cycle down and stay down, or is it going to cycle a little bit and go back up? Okay, let's look at the probabilities. Now, the global markets are still bullish, okay? I think that as long as no major correction occurs to the US market, then the bias is going to be up. Okay, and if you manage to break this resistance zone, if you can get past maybe 3,300, that really implies a move all the way back to the 52-week high, at least to 3,500. Okay, so I think the probability is to the upside. The probability is to the upside, as numerous markets have already exceeded their 2007 high. So basically the US, Taiwan, Malaysia, even the Eurozone, right, is already either exceeded their pre-financial collapse high, crisis high, or at the 2007 high. So key underperformers is basically China. It's probably dragging down certain parts of the region. But then even China has some signs of bottoming out. Okay, I know analysts and fund managers are mixed here, but they're definitely not as bearish as before. So it has signs of bottoming out. So basically all these markets have exceeded their highs and the underperformer is bottoming out. The bullish nature, some of the money will probably find its way into Singapore as well. But we have to wait for this consolidation to take place. Might take a while more before it actually breaks out. Okay, so we got to see whether the price actually can break out from the resistance, or will it fall back down to support. Okay, that was for the Singapore market. So we talked about the S&P, we talked about the Singapore market. I thought that since I only I only speak about markets once every quarter, I thought I would do a teaching corner. Okay, a teaching corner to do some stock-specific technical analysis. Okay, hope that's okay with you guys. Hope you guys will learn something from here. And in this particular case, I'm gonna just focus on the bottom. all right, that it's a good idea always that when you want to buy a stock, you must look at the fundamental case, that's for sure. And what's always interesting is if can you support your fundamental case with a technical target? Or how's this? If you have a technical target, can you support it with a fundamental case? And so this is going to be basically my case study for Valuetronics. I'm not going to go into detail into the fundamental case, because actually you can find out that in our earlier webinar. We had one webinar on Valuetronics, specifically on Valuetronics already. You can check that one out. But I just want to show you some things. Now, back in 19th of May, okay, this is when we first published the report on Valuetronics, where closing price was 33.5, and I initiated a target price of 43 cents. Okay, so since that time, actually, that's basically people have been asking me how did I know that the price was going to hit there? Because here's when I initiated the report back in May, and it hit 43 cents, and actually the price since then has been consolidating on 43. So if you've been looking at the chart, you'll know that the price actually has been fluctuating around 43 to 40. So it hit the target at 43. Okay, so that's the first one. Well, the interesting thing is, let me show you that this 43 is actually a coincidence. This price level is actually a technical objective. Coincidentally, it actually is a technical objective. Okay. Now, what is a technical objective? A price objective, sorry. A technical price objective. Sorry. Okay. Essentially, right, there's been studies on the probability of objectives being hit, and what is the objective? Objective usually relates to major reversal patterns or consolidation patterns. Okay. Let me just show you graphically what do I mean. So in this case here, we have a head and shoulder pattern. Okay, I've just drawn the neckline of the head and shoulders pattern. This is a classic reversal pattern, which I'm sure many of you are familiar with. Okay, the objective simply means this: if there's a breakdown, okay, the objective is, first of all, take the initial height of the head to the neckline. In this case here is $17, right? Project this head downwards from the neckline. So here's where it broke. Project it down here. This is your price objective. So this means that if there is a successful breakdown from the head and shoulder patterns, right, then this is the price objective where it will minimum hit this point here. That's called an objective. Okay. In this case here, it's a breakdown pattern. Here's your minimum price objective. Okay, and this is barring any other technical signal or support levels. Okay, it should hit here at least. Now, you can do the same thing the other way around. So here is inverse head and shoulders. Okay, here's your really small shoulder, ginormous mountain of a head, and then you have another shoulder here. But the key thing is that it's basically a consolidation pattern. That's the key thing, that is framed by a couple of resistances. That's the point. So in this case, it's the neckline. Here's the breakout. So we do the same thing. Here's the initial head, and project upwards from neckline, and boom, here's your minimum. Okay. So this is the objective. Okay. Now, Thomas Bukowski, in his book Encyclopedia of Chart Patterns, 2nd edition, he has actually done research on these particular breakout patterns. Okay, so in this case here, he is actually doing the statistics on this sort of pattern. Oops, the inverse head and shoulder breakout pattern. He basically looked at the US market. I think he looked at about 50 stocks, and he covered, I think, 4 year cycles. And what he would do is he would find all the times that a reverse head and shoulders occurred, and he will count the number of times that they actually managed to meet the price objective when there's a successful breakout. I won't bore you with these numbers, but I just want to I want you to draw your attention to here that in a bull market, the percentage of meeting a price target for a reversal breakout for the inverse head and shoulders was 74%. Okay, so this is a rough statistic. I know that we're looking at the Singapore market, and the numbers will probably not be the same, but we can still draw inferences that this phenomenon exists, okay, although we don't know what's the exact percentage. But here we can see that it's almost 3 to 1, right? So whenever you see a breakout like this in a bull market, the 3 to 1 chance that you actually hit your objective. Okay, and that's basically the case for Valuetronics. I'm not going to talk about failure rates here. It's just for your reference. Okay, so how do we measure it for Valuetronics? Well, you can't tell what it is from here, and that's why sometimes, technically speaking, it's hard to see sometimes. Where's the objective? But if I pull out the chart and I go back 6 years, now you see the chart pattern better. You can see, oh, wait a second, this is your consolidation pattern here. You draw a line across, you have an objective. There we go. That's the objective for the 43. Okay, is it a coincidence? You decide. Now what's interesting is that okay, this is not a head and shoulder pattern, by the way. It's not, okay? But the point of it all is that it's a consolidation framed by a top here, and there's a breakout from that top. Okay, so we can still apply the same type of principles. What about now? Now, more recently, we came out with a new report in which we increased the target price. This is a fundamental target price, by the way, okay? And the question that I get is, how can this go to 60 cents? Or at least, technically speaking, can it go 60 cents? What's the technical case, right? And the thing is, you actually can have a technical case. So I'm not saying that indeed this would definitely go to 60 cents. All I'm saying is that there's actually a technical case. Can you see it? Well, here's one particular resistance level, and it's quite significant. And what if I took this as my objective? Then you would actually hit here, almost 60 cents. But don't forget this. This is just one of them. Actually, the price has very recently broken out of its all-time high. This is its all-time high way back in 2007. Only recently it's broken out of its all-time high. And that also means that for those who are familiar with technical analysis, once you break out of an all-time high, there are no convenient resistances to measure from the past, because now you're in new territory. And so measuring from this point, it's also bullish, and it could easily head up here just based on the technical case alone. Okay, even fundamentally speaking, right? If you know that the old high was made in 2007, and it took you 6-7 years to get back to its all-time high, and you know that the company has been profitable the whole time. Now, earnings have gone up and gone down, I agree, but the company has been profitable the whole time. Okay, so even market / expectation wise, fundamentally speaking, yeah, the probability that the price should be worth more than 35 cents is extremely high as well. Okay, so this is my case study of Valuetronics for this individual stock. Of course, if you're doing technical analysis on a stock, it really does behoove you to know the story of the stock even during this consolidation. Okay, for example, I could tell you that in this consolidation here, coverage of the stock ended somewhere here in the beginning of 2013. There was no coverage here. Okay, and all this time here, Valuetronics was accumulating cash on its balance sheet. So the more cash it accumulates on the balance sheet, you can say in a sense, the more ammunition it is loading up for the stock to basically push out and go higher. All right. So okay, I'm done with the case study. Okay, and just want to leave you with our top picks here. That Josh mentioned earlier: Valuetronics, Lantro, Croesus. Okay, and we're still positive on these. Okay, so now we shall open the floor for questions.
Yep. Hi, this is Lucas here. I got a question on Croesus. The question goes: does your target price takes into account possible loss that the company had to incur while acquiring the assets in 2008 and 2009 when yen SGD was much higher than as compared to now? I think that firstly, you guys will really understand the transaction here. The sponsors, the partners, okay, originally acquired the assets back in 2008, 2009, and subsequently Croetia's Retail Trust only acquired these assets from them when they were listed, and the whole IPO took place in 2013. That at that point in time, the yen and SGD is really very similar to current levels. So there is no loss for the Croatians because while they purchase the equivalent of the assets in yen, they change the SING that they raised from the IPO to yen at today's at about 80 yen to SGD, and then subsequently use the yen to buy the assets from the partners. So there is no loss that they have made in the process of acquiring the assets in 2013. It's just kind of like really beneficial to us, Croesus Retail Trust, if you get what I'm trying to say right here. I hope that I was able to explain clearly what's happening on that front in terms of the timeline. There's another question on Croesus asking if there's any problem on Croesus as the director or the owners are selling. I believe that those stocks are actually awarded to the management because of it's a way of them getting paid on the management issue when they perform up to a certain mark. So no, there's no problem on Croesus, as in that everything is going really smoothly for them. It has been an exciting year for them, and ever since the plateau of 88 cents, they have since come to 95, 96 cents even. And they're actually looking at a potential acquiring of more yield accretive assets. So no, I don't see any issues. The next question: what do I expect? When do I expect interest rates to start creeping up, and what does that mean for REITs? Okay, I shall leave the interest rates portion to my the banking analyst, whereby he can shed better light and also give you guys further insight on it. But okay, for what does interest rate means for REIT? Well, it only means that the investor's valuation of the REIT will get lower because, well, REITs, majority of the investors out there, they look at REIT using a dividend discount model coupled with a RNAV model. RNAV measures the value of the assets as of current day, whereas the dividend discount model looks at the REIT as a whole and try to anticipate what their payout like and then discount it to current day. Another DDM model is very sensitive to the interest rate. So a rise in interest rate, it means that future cash flows get discounted more. And on that front, the current day value of the REIT from a dividend point of view may be lower. So the thing about it is, the next part of the question that this participant asked, is it too early to get out of REITs right now? I would say that right now, the better way of looking at REITs is actually to look at the growth of the dividend itself. If the growth of the dividends can far outweigh the increase in the interest rates, then I do not see why is it that that specific REIT is going to tank. So I would advise you guys to actually look at individual REITs itself. Try to focus on the growth of assets and the growth of the dividend for those that continuously provide strong growth, and they are also they have strong balance sheet that they can acquire more assets or they are planning to. I think that those REITs are actually worth investing in right now. As for the REITs that are stagnant and not showing much growth, not showing much movement in their assets, whereby the management is no longer that active on that front, then well, I would think that now would be a good time to get out of such REITs. Alright, next, I think there's another 2 or 3 questions on Croesus. What about FX issues? For Croesus, well, they basically right now everything that they have raised during the IPO has been converted to yen, and their operating currency is JPY, Japanese yen. So the only FX issue that they have is to convert from Japanese yen back to Sing dollars to be distributed to the investors during as and when they have any dividend announcement. So on that front, Croatia basically they actively manage this exposure by hedging, and they hedge about maybe 2 to 3 quarters early and even up to a year before the actual issue itself. So volatility has been reduced, but definitely they are still exposed in the very long run. I do not see the FX issue as a really big thing as of now between the JPY and Sing dollar. At least I do not think that there will be any major movement. For the matter, they are more for the foreseeable year 2014, upcoming distribution, and also for 2015, they are largely hedged already. Yep. Another question on Croetia's, and the question goes like this: Croetia's retail trust shopping centers, are they profitable or popular? For the first part, I think that it's more important to look at the fundamentals of these shopping centers. They are all 6 of them are definitely profitable. The net operating income or net property income yield will range anywhere between 5.9 to 6.6, the high 6, between 6 to 7% property yield. Coupled with a leverage of 53%, that will be about 9% yield for the equity investors. So yeah, they're very profitable. Are they popular? Well, I think that it's more important to be for the real estate, the location, the real estate fundamentals, like the number of footfall and where they are located. It's important to be strong on that front than just being popular. Like for example, if you're located within the most famous shopping district in Japan, it does not mean that your shopping center is really profitable. It does not mean that your shopping center can stand the test of time. But for Croatia's Retail Trust, their shopping malls are largely located in places whereby there's a lack of competitor, whereby they're the only mall within the 2 to 3 kilometer radius, or they're located in places with very high connectivity. They're sitting right in the middle of a traveling node. So on that front, I believe that their real estate fundamentals for all the 6 shopping centers are very good. And comparatively, if you're talking about how profitable they are definitely on a very stable 6%. I know is not great in Japan standard, but the thing about it is they are able to have very long lease expiry, like almost a double digit for average for the portfolio. So the current 6%, okay, can last for the next like 8 to 9 years. So on that front, I think that is very good. Another question on Croatia's. The next Croatia's dividend is around the corner. Expected date / month and amount. Okay, I don't think that this is really the time where they're going to have their 4Q report out, and obviously the full year result out will be in August. I would think it's mid-August. I cannot say with exact knowledge of it, but I would think that it will be when they issue their 4Q results, they will also announce a dividend. So yeah, mid-August. Alright, shall I hang on to the next analyst to answer the questions? Interest rates.
Hello, good afternoon everyone. Benjamin here, the banking analyst. Just now Lucas was mentioning about the outlook of interest rates. So currently interest rates are still pretty much tied to the US side. So if you look at the US interest rates are still pretty low now. But in terms of the outlook, previously my call in my banking report, the outlook was that we expect the interest rates to start moving up in around the midpoint of 2015. Okay, our basis for making the assumption is because if you look at the current US data, it's looking very solid and robust. The non-farm payrolls have been increasing month on month, as well as the unemployment rate has been going down as well. So I mean the Fed controlling the Fed fund rates they have been making all these decisions largely based on data dependency. So we look at that. In fact, the market has been pushing their estimates of the interest rate increase forward. Some of them, some of the consensus are even calling for between March to June for the first interest rates to move up. So that's roughly the outlook that we have. So just keep in mind that I was expecting 2015 anytime before June, or around June. That's where we can expect interest rates to start moving already. Yep.
Alright guys, just hold on a second. I'm just going to black the screen just for a little bit. Yeah. Okay, then pull out the web page. Okay, don't be alarmed. I'm just pulling out a web page. Relax. Okay, that might not be out. Okay. Alright, I had a quick question on China, right? So the question is, just elaborate on the China composite chart. Okay, that's a really tricky one. So I'm just going to pull out the chart and show you like right now. What do I see? Alright, if you pull it back 10 years, the reason why I said signs are bottoming out is because right now, as you can see, we've had this bullish move here followed by essentially a 5-year retracement. It's a descending triangle which bounced off support multiple times at 2000. So now we are at a price point where it's basically going to break out either downwards or upwards very soon. If you draw a line down this trend line of the retracement, the price is slowly getting to the end of that. When it gets to the end of that, it's either going to break on the upside or break on the downside. Okay, it is actually not a good sign that you've tested this support multiple times like so. Okay, hence just as a technical analyst point of view, I would definitely want to see the price not break down this level. So perhaps you can play this on a short term because the global euphoria, China data is improving. If you want to play that news, at the very least, I'll wait for at least some sort of bullish candle, some sort of bullish move to show that the price is allergic basically to this level over here. Right now, I don't quite see it. Let's go further in. Okay, what do I mean by allergic? Okay, what I mean by allergic is something like this. Okay, I'm gonna go deeper. Sorry, let me just go closer. Okay, something like you need to see some sort of reversal pattern, some sort of very bullish move. I don't want to see such grinding up moves. This move is not very strong to me. You need to see something like on the order of let's see, like this. See, notice over here you had this breakdown of this resistance line here. Support line, breakdown and a quick reversal up. This is considered, this is like really quite severe, and this tells me that this line is going to be supported. If you see something like that, right, I mean that would be good. As of now, all I see, the price is just drifting sideways / downwards, and it's hard to call either way. Yeah. So that's all I have, unfortunately, for China market. A quick question. TP stands for target price. Okay. Also, another question on SodaStream. Okay, the thing about SodaStream is that right now it's a magnet for news. Okay, because its growth potential is very high, but at the same time, so essentially there's good news and bad news going for it at the same time. This causes a lot of price volatility. But at the end of the day, because SodaStream's growth will occur only next year, because management has really guided single-digit growth this year, I suppose any negative news will outweigh the good news. But let me talk about the good news and the bad news. So the good news is this. Actually, growth in Asia is actually doing well. In fact, just recently, news from Samsung is that the Samsung Zypel sparkling refrigerator has proved successful. And because of that, Samsung is basically adding in the SodaStream. It's powered by SodaStream, don't forget the refrigerator. They're going to add the function permanently, and they're going to add it to another refrigerator. That means Samsung is now essentially increasing their exposure to SodaStream. So this shows you that the demand in Asia is doing well. At the same time, in Korea itself, the market for sparkling water is slated to double this year. Yes, it's slated to double this year. Apparently, this fad of soda water is getting everywhere. I found out also that some celebrities are even using sparkling water to wash their faces with. Yeah, you heard me correctly. They're actually using sparkling water to do their facials. So as you can see, this is actually growing quite big in Asia. So that's the good news. See, so that's why the potential for SodaStream is very high, because as the soda market, sparkling water market increases everywhere worldwide, SodaStream has the biggest lion's share of it and will benefit. But at the same time, because SodaStream has always been politically charged, and there have been some political protests in UK because their manufacturing plant is, in the West Bank, and essentially, the negative news caused them to essentially close some shops down in the UK. So with the growing market plus political bad news, it causes a lot of price negativity. Unfortunately, because SodaStream's earnings will come next year, the bad news will probably outweigh the good news, even though the good news does show that its prospects are still very healthy. That being said, if you're looking for a downside support level, I think $30 is very good support, because $30 is a technical support, and at the same time, $30 also implies a PE of basically 15 or 14 to 15. And 14 to 15 times PE for a drink company with single-digit growth is actually very, very reasonable. Oh, okay. We've got this comment that the teaching corner on Valuetronics was excellent for education. Can we have one such study every Monday? It will be a little difficult, but rest assured that research, we are still trying to produce some ways of actually doing education, and when that happens, we'll let you know. Where can we get the sector rotation graph? Unfortunately, at this particular point in time, the only easy way of getting it would be from Bloomberg. As of this point, I don't know any easy way for retailers to get hold of that particular sector graph. Okay, thanks everyone for your very kind comments and questions, and we are done for today, and we look forward to see you next week. Go tell your friends. Okay, thank you.